Thank you very much, and thank you, members of the AIFA, for having us over here. I see our audience getting larger and larger every session, so it's very good work done by each one of you, and many congratulations. So, taking off from where Mr. Menon left on behavioral finance, I think that's a very important aspect, and my presentation today would be on behavior, how investors behave, and how is it that as a distribution community we can try and sort of manage their behavior, which will help increase their wealth and therefore increase the AUMs that we also manage. So the topic of my presentation is your behavior determines your wealth. It is both the behavior of the investor as well as the behavior of our distribution fraternity. Right. Now there is a data which shows that there is a big difference, significant difference rather, between what is called as the investment return and what is the investor return. So the investment return is actually determined by what is the return that a asset class actually is providing, whereas the investor return is actually what the investor is generating for himself or herself by investing in that asset class. The difference between the two, and it is generally found that the investor returns are lower as compared to the investment returns, and the difference between the two is what we call as the behavior gap. The difference is as a result of the behavior of the investor, which the investor is essentially responding to various sentiments in the market, volatilities in the market, and which is causing that gap, which is causing the difference in the returns gap. So if you look at some data, you will have the blue chart, which is the investment return, and the orange bars, which is the investor returns. Over a 10-year period, you will generally see that there is a difference of about 2.5% plus, with a potential gap of about 71 lakhs on an investment value of 1 crore over a period of 10 years. So it's a significant value that is being destroyed because of behavioral gaps that the investor may have. And this is what I will try to address in my presentation. Now, we've seen this graph. I think this graph has been a cliched graph from the mutual fund industry over a very long period of time. This shows the S&P BSE Sensex over the last 44 years from March 80 till date. And this graph clearly shows that there is a growth of about 15.24% CAGR. That's the return that the markets have broadly given. This is the Sensex returns that the market has given over the last 44 years. Now most of us have been in this industry for a sizable period of time. And I would like each one of you to ask this question to yourself: how many of your investors have actually generated 15.24% CAGR over this last 44 years? Now there will be a difference in this return and investors over a long period of time, and that is what we need to be highlighting here. See, there have been a lot of ups and downs in the market. We have the BOP crisis in 84, 85, right down to the global sell-off and the coronavirus. There has been a lot of ups and downs in the market, but net, the market has given about 15.25% CAGR return over the last 44 years. Another factor that we need to understand here is that there is a difference between returns and volatility. Returns will always be dependent on the volatility of different asset classes. If you look at the GDP growth rate, if you look at corporate earnings, and if you look at Nifty 50 TRI, the returns, the growth of the GDP, the growth of corporate earnings, the growth of Nifty 50, all are different. But at the same time, there is a huge difference in the volatility. So if you look at the GDP, which has grown at about 12.7% over the last 20 years, giving a volatility of only 4.7%. However, the Nifty has given returns of about 17% with a volatility of almost 31.7%. So the point that I'm trying to make here is that volatility is part of the return game. We have to look at volatility as a friend rather than a foe, and therefore not respond too much to market volatilities, because that is part of the game, that is par for course for generating returns. I think this is pretty clear to everybody. This is back to basics. Investments, returns. We need to behave like a marathoner rather than a sprinter. We need to be in the market for the long term. There are different qualities that a marathoner has vis-a-vis, a sprinter. A sprinter is more like a speculative stock trader who does almost transactions almost on a daily basis, whereas an investor behavior is essentially something which is for a much longer period of time, and those are the qualities that we need to be inculcating amongst our clients. Another point that can be discussed with clients is that this is a data which has been there since the last, again 25 years, since 79 till March 24. The percentage of days over these last 25 years or over these last 45 years where the markets have been making all-time highs is just about 7%. Just about 7% of the days the markets have been making all-time highs. In fact, percentage of days where the markets are a 52-week low is about 9%. So it's not that the markets are on a linear upgrowth. So there are lots of times when the markets are falling, and that is something which is part of the market cycle, and that is something that we need to make our customers understand, that it is the volatility in the markets that is going to determine your long-term returns as well. Giving another example, we have the example of a very famous IPL franchisee and a very famous captain of the IPL franchisee and a captain of the Indian cricket team. Now, this gentleman, did he get 100% of his decisions correct each and every time? If you look at the strike rate, if you look at the winning rate, he has, as a captain, he has failed to win the IPL in 7 out of 12 attempts, which is more than 50%, right? But is he a successful captain? Is he regarded as one of the best, finest captains, both of the IPL franchisee as well as of the Indian cricket team? Yes, he has been. Even if he's got 50% of his decisions or the winning rate correct, still he's regarded as a very successful captain. So it's not necessary that we have to have 100% accuracy in terms of getting our decisions, financial decisions right. Even if you are there 60% of the time, you are through. I'll give you the next data point here, which is, again, over the last 45 years, 53% of the time, 53% of the days only is where there has been 1 day positive return. And negative is again 47%. And if you look at it, the positive days have just given about an average of 1.07% average returns positive. Negative is minus 1.05. And we are looking at a time period of about 45 years at about 10,450 days. So it's a 50-50. One needs to understand it's a 50-50 on a positive and a 50 on a negative. Even that has given about 15.25 CAGR over 45 years. So the point here to remember is, you may get decisions, you may not get your 100% of your decisions right, but if you stay for the course, you are still making phenomenal returns. And that is what we need to understand. We should not be looking at multiple calculations, multiple decisions that we need to make, but stay par for course. Again, SIP, we all know SIP is a method which can help us manage this volatility. Volatility is here to stay. It will be there. It was there in the past. It will be there in the future. SIP is the way to manage volatility, wherein if you look at instances over the last, again, 15 years, more than 88% returns was 87% of the times, right? 157 instances of the last 180 instances. And at a 5-year SIP returns in the market was at minus 2.0 when the market fell during the COVID pandemic. However, 1 year from this, at March 2021, the market bounced back to about 15.25%. So it's a real bounce back, and the SIP method really helps you average out the volatility. This is a product, this is a way to invest for all our retail clients, because that helps for long-term averaging of the cost. Another aspect that a lot of customers look at is point-to-point returns. What has been the returns in small cap over the last 1 year? What has been the return in gold over the last 2 years? Generally, clients look at this and make their investment decisions based on short-term point-to-point returns. What is more important to look at is actually the long-term rolling returns. Short-term one-to-one, point-to-point returns may give a misleading picture for long-term investors, because over a period of time, all asset classes tend to average out in terms of their returns. It is important to take in mind that your long-term rolling returns. So if you give an example of these two, if you look at large cap, mid cap and small cap, as of March 31st, 2024, your 1 year and 5 year point to point returns, if you look at mid cap and small cap, was at about 64 and 57, and with a standard deviation of 23 and 22.5. However, if you look at rolling return, 5 to 10 year rolling return, mid cap the returns averaged out to 33.6, but what is more important to look here is that the standard deviation of the mid cap was at 45 for a 5-year period, but came down to 5.5 for a 10-year period, even though the returns fell. So both, if you look at the risk assessed, the risk mitigated returns, you will find that long-term rolling return is a much more appropriate method for long-term investors to look at and base their investment decisions on. You may have small-term returns in the shorter run in some asset classes, but if we are looking at the long term, I think it is very critical to look at the rolling returns. So it is not about, market cycle is not about predicting the future. It is about understanding the probabilities involved. So what is seen, generally we'll see, a lot of growth happening on top, but what is important is and the underground is not actually seen. So we need to look at these fundamentals which are probably not very evident, and keep that in mind when we are advising our customers to invest for the long term. Again, there are some market myths that is important, and these also affect behavioral investment behavior, because there are myths in the market that the yield and the stock markets are opposite to each other. However, if you look at some data points, which is, let's say, in 23-24, and you look at 2008 and 9 as well, you had the 10-year gilt and the markets going up in the same direction and coming down in the same direction respectively. So some of these market myths drive us to make some decisions which may not be appropriate, is what I'm trying to communicate. It is important to understand that there are possibilities where you may have situations where the markets move opposite to preconceived notions, and we need to keep a lookout on those parameters. It is not important to look at one parameter, but it is important to look at multiple parameters when you're looking at investment decisions. This is a very interesting slide, and this slide actually gives a very clear picture of what investment behavior should not be. Okay, and this is a very clear data point that we took out from the market. Now this is data from 2008 to 2024. These are the times. So we have found out when the market P was less than 20 and when the market P was more than 20. Now PE may not be a very accurate figure, but it gives a very strong indication of whether the markets are overpriced or the markets are underpriced. Okay, so given that when the market P was less than 20, right, the next 1 year forward average returns was about 28%, 3 years was about 15.62%, and when the P was more than 20, obviously the next forward year earnings were much lesser. One of the data points which is missing in this slide is when the market P was less than 20, what was the inflows into the equity capital markets over this period from 2008 to 2024, and when the market P was more than 20, what was the inflows? When the market P was less than 20, the total inflows into the equity markets was about 16,000 crores. Okay, 16,000 crores was what the inflow was into the markets when the market P was less than 20. When the market P was more than 20, anybody can take a guess what was the inflows into the capital markets. To make it interesting, anybody can take a guess? Sorry? 10 times more, which is about 1,60,000 crores. Okay. Anybody else? The inflow was 11 lakh crores, which is totally opposite of what investment behavior should be. Just see this. When the market P was more than 20, we all know, and this fraternity, I don't think anybody would deny the fact that that is when we need to be cutting down on our equity exposures. That is when the inflows were 11 lakh crores, and when the market P was less than 20, the total inflows was 16,000 crores. So this is exactly opposite of what investor behavior is. This is what makes the difference between investment returns and investor returns. This is the behavioral gap that I'm trying to highlight here. Okay. Again, so whenever I evaluate an entry price, one should always look for a margin of safety between the gap between the entry price and the price in a scenario in which most of the positive assumptions don't pan out as expected. So we need to look at the entry price, which is extremely critical whenever we look at investing into any asset class. The net thing is that the entry point of getting into an asset class is very important. At the same time, we should not be timing the market, and therefore the SIPs are the best ways to look at long-term wealth creation. Now, there's another method, another way of looking at wealth creation, and that is called asset allocation. I think somewhere down the line, when we have these waves of small caps doing well, mid caps doing well, they have done well and they will continue to do well. It's not about that we are anything against mid or small cap, but there is something called an asset allocation, which sort of gives a sort of systematic approach to determining how to place your investments. Asset allocation essentially looks at various asset classes. As we all know, in mutual funds, we have broadly debt and equity asset class. If you look at the last 20-year period, if you look at equity returns, the returns have been at about 15 years CAGR with a volatility of about 21.6%. Debt, on the other hand, has given about 7% returns with a far lesser volatility. So it's about the risk-adjusted returns that I'm talking about. Both debt and equity have a negative correlation to each other, and therefore they make a very good option of combining the two together so that one hedges against the other when the markets are antagonistic to each other. Now, if you look at this chart, you look at 100% equity allocation over the last 20-25 years, you get a 15% return, as I mentioned earlier, with 21% volatility. A simple 50% allocation between debt and equity brings down the return by about 350 basis points, but this is what is more important. It brings down the standard deviation too by almost 100 basis points. So risk and returns go hand in hand. Customers need to be made aware of the risks that they are facing, and it is important to understand what asset allocation can provide to a customer when a customer is looking at long-term investing. Long-term investing is always about risk adjustment returns, and asset allocation is a method to try and mitigate the risks. Some of the strict no's that we should be looking at in terms of giving advice to our customer is putting all the money in a single investment, investing with borrowed money. That's always a big no. Some of the things which is important to note here is that while a lot of changes, like you have the saying that change is a constant, but there are some things that we should remember is never going to change. Now, for example, as Mr. Bezos says, customers would always want low prices and quicker delivery. That's the mantra of a customer. Like they will always want, that will not going to change in any scenario. The lowest prices and the quickest delivery. Now, what is important for us to understand here is when the customers is looking at the best returns in terms of long-term wealth creation, what is important in the formula of compounding interest, which is amount is equal to principal into 1 plus return raised to the power t. The t part, which is the compounding part, is the most important factor in this formula. When you're looking at elongated t's, that is when you are generating real wealth for yourself, and it is important to manage behavior in that period of time for the customers to generate wealth for the customers as well as generate AUMs for the distribution fraternity. I think it is important. Mr. Menon made a very important observation, which is if you are creating a wealth, if you are creating a corpus for your customer which is beyond a certain limit, and even if there is an SWP from there, that corpus keeps on growing and growing and growing. That corpus remains with you. It is wealth for the customer, it is a corpus for you. So both of them, it's a win-win for both scenarios. So we need to understand the concept of time in investment behavior. We need to understand that the behavior of a customer will drive what is the degree of wealth he or she is creating for themselves, and that is what we need to communicate to our clients in the long run. A final wrap up. I think what is important to understand here is that investment is a marathon, it's not a sprint. Markets are more volatile than economy, and earnings market will always give you bigger returns, but will always have more volatility. Your economy and growth of the GDP growth and the earnings growth will be lesser, but the volatility will be lesser. Volatility is a feature. It's for our own advantage. It's not something that is working against us. We need to look at it as a friend for investment. You do not have to win every time to be successful. As I mentioned, as I showed, 50% of the times if you get your decisions right, you are winner. The markets over the last 45 years have been positive only 53% of the days. Yet it has given 15.25 CAGR returns, and that's a significant growth that the markets have given. Always consider rolling returns as compared to point-to-point returns, because rolling returns always give a better risk-adjusted scenario. The average returns are much better reflected. When you take decisions based on point-to-point returns, there are chances that you may go wrong as compared to when you are comparing rolling returns. Stock markets will always surprise you. There is no fixed parameter where you can align a particular parameter to the returns that the stock market will generate. There will always be a gap. Therefore, please do not try and predict. There are a lot of things you will see, there are a lot of things you may not see, and that might surprise you. So it is not in everyone's interest to sort of try and predict the stock market and determine your investment decision based on that. Valuations, always look at valuations which give you margins of safety. Asset allocation is again a very important feature of investment. It helps moderate the risk associated with different asset classes, and it is important to look at asset allocation in a holistic manner. Diversification is key to survival. Please do not leverage. What will not change? Customers will always want the best returns in the possible for their investments that they do. In the compound interest formula, T is always more important than the R. Rate of returns is important, but the time period that you stay in the market is equally, if not more, important than that. Thank you very much for being a patient audience, and it's wonderful as always to be here. Thank you.
Thank you, Siddhartha ji, for that crisp, short, and wonderful presentation. Can we now have on stage, along with Mr. Siddhartha Dash, Mr. Joseph Xavier, Regional Head Kerala of UTI Asset Management Company, Mr. Subramaniam, Vice President, UTI Cochin, Sir, a very special moment for all of us now. Please allow me the liberty to call upon on stage Mr. George Samuel, Senior MFD from Cochin, whom we fondly call as the Bhishmacharya of the MFD fraternity. I also call upon stage Mr. Jagadish Pai, President of AIFA, Mr. Joseph Xavier, a very familiar face with all of us from UTI Mutual Fund, has put in a service of 31 years with UTI Mutual Fund and is retiring within the next 1 year. So, as a token of our respect, love, and gratitude to Joseph Xavier, sir, requesting our senior most MFD, Sri George Samuel G, to adorn Joseph Xavier G with a punada, requesting everyone to kindly rise and give a wonderful round of applause. A small token of our love and respect to Joseph Xavier G. 31 years is not a small joke. We have MFDs here who are not even touched the age of 31. Sir, 2 words from you, sir.
So it was a nice journey starting from 1993. So I was lucky to witness the growth of mutual fund industry. The first product of mutual fund, it is UTA Master Share. So I started with UTA Master Share, and at this stage, if you see even the Kerala AUM is touching 85,000 crores. Such a big, that growth was fantastic and it was amazing. So I was lucky to be a part of this mutual fund industry, and it is like Ajit Menon sir told, it is not retirement. It is going to be my second innings. Thank you all.
Thank you, sir. Can we now have Mr. Sanup Siddiq from AIFA Ernakulam chapter trying to hand over a token of our appreciation? But before that, we have, Sanup, please come. We have one lucky draw to be taken by UTI. Siddhartha, sir, request you to kindly draw out one lot. Number 218. Number 218, second time. 218, third time. 218 is cancelled. One more draw, please. This time it is token number 124. 124. Yeah, we have one person coming. Token number 124. No one? 124 stands cancelled. Number 435. 435 second time. 435 third time. Going for the next number. No, sir. Okay, Joseph, sir. Eyes down on your tokens, please. Number 137. 137. Oh, Niranjana, the newest MFD from Ernakulam chapter. Will be handed over by Sanup Siddiq.